tradings, you can also lose a lot of money in the stock market too. My name is Sobi Kenobi, and today is lesson number 7 of Gowinvest 101, Risk Management. Today we're talking about exactly how much money you should start with and what you should do with your money when you get it into the stock market for trading. So don't trade everything you have. Hope you like today's lesson. I didn't think you could go that negative. These people lose more money than they even have. This is something called Lostborn. A lot of people do it. A lot of people have traded money that they couldn't afford to lose. And you see drops of $20,000, $15,000, $10,000, $100,000. I want to see some good ones here. I mean, this one is by far takes the cake at $730,000. But yeah, just like you can make money, you can also lose money. In fact, the majority of people, let me see, percentage-wise, percentage of day traders that lose money. It says that 95% of all day traders lose money. So, and then it seems like even though that might be what's reported, there might be a ton of people who are kind of keeping it undercover and it's like, oh no, I'm not losing that much. And the real number is closer to 98%. So, my question to you is, what makes you special? Today is lesson number 7, and we are talking about risk and risk management. So what makes you so special? You know, I tried doing this trading thing. I lost money. Everyone else I know who started out lost money. I think it's kind of like a rite of passage. You have to go through the cycle. You have to make losses. So, keeping that into mind, how do we best prepare for a loss? You have to prepare. Prepare, prepare, prepare. Okay? So, how do we do this? Number one thing, number one rule in investing is don't invest anything you couldn't afford to lose. And that is a general aspect of life. You've seen the Bernie Madoff scams. You've seen stock market bubbles. You've seen, people almost kill themselves because all their money is gone or they have debt obligations and things like that. So don't invest anything you can't afford to lose. All right. So how do you do this part? Make sure you have 3 months of subsistence. Which is food, which is rent, which is gas payments for car. Any type of car payments. If you do have car payments, I would suggest don't even to get into a car with car payments. Just buy a used car if you were down this road. So you got food, rent, gas, bills, anything that is on the that you would potentially spend anyway. Say you lost your job and you couldn't make money. This is what you need to have. You need to have 3 months of this before you do any investing. Keep this in the bank. All right, number one rule is you got to have 3 months. Okay. After that, how much should you invest? My suggestion to everybody is invest only $300. Only. And the reason being is if you can't grow that, you can't grow, then there's something wrong with your strategy. There's something wrong with what you're doing there, that this is not enough for you. You know, if you practice, you learn on $300. All right, you are not yet at the level of trading that you can afford to lose anything more than $300. I'm hoping that none of you guys are at that level where $300 is going to make a huge dent in your wallet. If it is, then you guys got to start working from the ground up. Maybe look at some job postings, look at some side gigs, maybe DoorDash or something to do, something to start bringing in some cash. But if you have $300 to spend, it's time for you to learn. Okay, part two. How much, so say I have an investing account. I have money coming in, maybe a solid job. I have money to invest. What do I do with it? Okay, and I suggest you create two accounts. All right, one is your long-term account, and one is the trading account. This long-term account you use as like a bank account mostly. This is where you're saving. This is what's growing. Okay, this is in some sort of ETFs, like maybe SPY or something. It could get into Vanguard traded funds. Vanguard's another broker that doesn't use payment for order flow, and they're very good on getting you a high dividend yield. There's also BlackRock, but yeah, I mean, this is where you would keep your money. And then I would also suggest putting into some crypto like Bitcoin, ETH, or Cardano. And I would suggest doing this after the Tether crash. Tether is a coin that's giving liquidity to the market at the tune of 62 billion. There's a good video of this from CoffeeZilla. I'll link it up on top of this so that you can see what that's about. But basically, something's gonna happen in this liquidity pool of the markets that's gonna kick the coins prices down, because not everyone can cash out their coins. It's gonna create some sort of a fear in the market, and you're gonna see a drop in all cryptos. And I don't know whether that's gonna happen before Bitcoin skyrockets, but I would suggest that if you are doing long-term trading, you keep this after the Tether crash. The other thing to do is maybe some tech plays, stocks. I have good sense of Google, Apple. Apple's coming out with their car. They're coming out with Apple glasses. Google has Google Glass that's coming out, and they're also trying to compete in that space. Tesla's already overblown. I wouldn't suggest putting money into that. I'm put money into what can potentially hold some value, which are these two companies. They don't have and they've played it very well, I would suggest, and I see them having a huge impact in the future. So that's why I'm saying this is your long-term account. This may go up by 0.12%. This may go down by 0.15 to 3%. Don't panic, it'll eventually come up, but this is where you're putting the majority of your investment money. And the reason being is this will generally grow faster than inflation. If the dollar value goes up, these prices, these companies, um, net revenues go up, and they basically hedge against inflation. But your trading account, what should you do with your trading account? So my suggestion is 30% trading, 70% long term. And long-term stocks, you make sure that those are separate on a separate broker than you're trading. The reason being is everyone gets those mad days, you know, where you lose a ton of money on your trading account. Maybe a market crash happens, maybe something occurs. If you're just not very well versed in the market, you can go crazy and you can start making random options calls, moving money around, and you'll generally like be losing in on each case. Like you'll do things that you think you'll do things that you think will make money, but really will just end up losing you a ton. So you want to make sure you cannot just jump into your long-term trading thing and just like, you know what? Let me pull some of this out to make back my losses. Nope, those are losses. You have to cap your losses. So 30% trading, 70% long term. Now we get into what about every individual trade? So let me delete this background color. Okay. So how much per trade? And I suggest something called the Fibonacci double down, or what I call it. I don't know what it's really called. Fibonacci DD. And the reason for this is what you do is you take your money, whatever money you had. Say you had $7,000. Okay, so you do it 1, 1, 2, 3, and then 5. You have 5 there, but you really don't use 5. So you have 1, 1, 2, and 3. And the reason being is you break it down into those units. So it'll be 1,000, 1,000, 2,000, and 3,000. So this is 4,000, this is 3,000, add them together, it's 7,000. So you have 7 units of your money, each of them are 1,000, and this is how you break it up. So say you see a trade, a good trading opportunity. You pop in $1,000. It might go down again and lose some value. But then what you do is you pop in another 1,000. If you make it back, you are overgained. So like you've averaged down here, and then it comes back all the way up, and you've made this much money. Now, assume you went down, and then you go down again. So you've lost, let's say, this down to 250. You put in 1,000 here. This lost down to 500. Okay, so this lost double down. This lost half. You're right now sitting at 750. And then here you put in 2,000. So you're 2750. At the low, you're at 2750. If it jumps up even to the midpoint, so that's almost a doubling of this from this factor, you would have made it back to 5,000, which is more than the 4,000, 5,000, and some change because 2,500 would be that. So you have 250, 5,500. So 5,500 is greater than the 4,000 you invested. You made money. Now let's say if it tripled down. All right, you've got 1,000 here. You got 1,000 here. You got 2,000 here. Then you better believe that 3,000 here. And that's your last play. If it goes down even more, I don't know why you didn't read the news, but it is a bad day for that stock. All right. But basically, if you've been following the Bollinger Bands, you've been following the cycles of MACD, there's rarely a case that within a day it can go down this much without bad news. All right, and I will go through some statistical analysis through this afterwards, but this is what I like to do with trades, because if you get into what you think is a good trade with, like, say $10,000, all your money, then if it goes down, you're like, this is a way better point to buy in because it went down even more than where I bought it at. But you have no more money to double down in. No more money to put towards that position. So my suggestion is the Fibonacci double down. This is how I like to trade, and would we do it if my account grows any bigger than what it is. Right now it's sitting comfortably. This morning we bought into AMC at the 53.60, and currently it's trading at 58.81. I will go back into showing you the account value, and the account value is up $47. I don't know if you can see it. It's kind of a little buggy here. I guess that's the problem with this visor thing. But AMC, go into the positions. It's up $47 if you can see that. So that is what my account's at right now. We are closing in. This used to be like 400, maybe $60. We're now at $530. And hopefully we'll grow this. And when we do, I'll show you some of these Fibonacci double down strategies, and you can see how well they work for risk management. Okay, until next time, see you guys. Bye.